In this section, we're going to be talking about risk reward ratio. Let's see. In this section, we're going to be talking about risk to reward ratio. Now, this is very important in trading um, because this can give you an overall view of the math that it takes to become a winner. Some people just think having a high win rate is going to make you profitable. But if you have a high win rate, but the losses that you do take wipe you out, then you're not really profitable. So you have to understand the math of your trading. So I'm going to really dive a little bit into this, show y'all how I personally view it, but I'm also going to show you how you should view it, just a basic view of it, because I'm a little bit deeper in my trading career. So I don't want to give y'all advice that you can't really comprehend with yet because you haven't had enough chart time, depending on who you are. So I'm going to give you how the basics are looked at when it comes to risk reward, and I'm going to tell you how I personally look at it. So before we actually go to a chart, I just want to explain risk to reward in this basic setup. And this pretty much what this chart is explaining which risk reward you can have to be able to be profitable in confluence with your win rate. So with a 1-to-1, as you can see right here, with the 1-to-1, you can have a 51% win rate to be profitable. So that means 51 wins and 49 losses, because if you're making $10 and you're losing $10, that means the losses are equal to your wins. So you can you can make one more trade, then you lose 51 over 49 and you'll be profitable. Now with the 1-to-2 risk to reward, you can now have a 34% win rate and still be profitable, because for every one win, you're making double that you make on a loss. So say for instance, you lose $10 on your trade and you lose $10 twice. You lost and you lost. You're down 20. Well, that one win will automatically put you at break even, and your another win will automatically put you at your up 20. So if you have 2 wins and 2 losses, you will be up $20 if you're going for a risk to reward of 1-to-2. So now, same thing. If we go here, you see that you only need a 26% win rate to become a profitable trader with a 1-to-3 risk to reward. It says that you can have 26 wins and 76 losses and still be profitable if you go for a 1-to-3. Now, this is very powerful in trading, just because, yeah, it just gives you a different perspective. It makes you be able to understand, like, hey, if I wait on different setups, if I wait on high probability setups, I can be a profitable trader. Now, like I said earlier, we're going to get into the chart and I'm going to show you an example of a high risk to reward trade that I would personally take and that I take on a daily basis. But personally, the way that I see risk to reward, and we'll go to the chart before I dive into it. But the way that I see risk to reward is I just take my trades based off structure. I'm not set to a particular risk to reward. Like, oh, I'm only going to take a 1-to-2. I'm only going to take a 1-to-3. I just follow what the market is doing, and I see the respect of the market in the direction of the trend that I do see fit. If I see that, hey, price, I'm getting into a trade, but price on the higher time frames is not fully trending in that direction, I would be crazy to take a 1-to-2 or a 1-to-3, depending on the setup. I just want to get in and get a couple pips, maybe 15, 20 pips, and get out, because the market can turn on you. Now, if it's an overall trend to the upside, then yeah, I might hold that trade for a 1-to-3 risk to reward or whatever. So it just depends on the structure of the market for me personally. But I wouldn't say every trader should go about it that way. I would say when you're first starting off, maybe you do go for a 1-to-2, like you risk $20. Your target is $20 and your risk is $10, or a 1-to-1, and just keep it very simple, because your hit rate might be higher. When you do have lower risk to rewards, like a 1-to-1, your hit rate, ideally, if you have a solid view of the market, is going to be a little bit higher. So here I'm going to give you an example of a good risk to reward. Let's get that battery off. So this is a really good example of a high risk to reward. Let's start off on the daily time frame. I know y'all see all these lines. We'll go to the 4 hour. I don't feel like seeing all these lines. Okay, so boom, this is what I would see on the 4 hour. And this is a good example of a high risk to reward trade. On the 4 hour, you can see the break of this area. But I would have seen a high. It create price created high. So imagine these trades, these candlesticks are not here. So price created a high up here, and now price came back to the area where the last high was created here. So I already know, like, this is my area of value. We're going to get deeper into that on another trade. So once I identify the area of value, price already retraced down to this area, I would be looking at a smaller time frame like this. So right here, we have a lot of consolidation at our area of value with candles closing as hammer candles at this level. So with me seeing this, I'm not just going to look down at the hour. Once I get this confirmation on the hour, I'm then going to scale down even lower. That's just how I personally trade. I'm going to scale down even lower, and I'm going to identify this area, and I'm going to wait for it to break out of this area and confluence with this time frame. So we're just going back to the hour. I think it's cleaner for us to see it on the hour. So yeah, I'm going to take this trade. The risk, I would put my stop loss below here, and you can put your take profit above here. But the price jumping out of this location and coming way up here is based on a higher time frame. So that's why I start off with the daily. Once we look at that daily time frame, we see, hey, this could trend on a daily time frame, then yeah, we can go up. So if we put our position here, if our stop loss is here and our take profit is somewhere in this area, this is a 1 to 9, a 9 to 1 risk to reward ratio. So that means I'm betting that I'm going to make 9 times. If I hold this trade out, I'm going to make almost 9 times what I would make on a loss. So that means if I take 6 of these trades and lose all 6 but win 3, I'm still a profitable trader because I have a 9 to 1. So this is just an example of a good high probability setup that you could take, and you will have high risk reward ratios. But this is what I look at when I look at high risk rewards. Now, if I'm just being honest, let's go back to the main screen. Now, every trade I'm not going to hold for that long because the market can go in the opposite direction. The market can be looking one way and just completely turn and stop you out. So on a trade like that, when I've got higher time frame confirmations, then those are the trades that I would take the high risk reward ratios on. And for a beginner trader, I would say, even any trader really, you would much rather want to take those high probability setups and have less time in the market than to take a bunch of trades and just not have a higher win rate. So hopefully y'all got a good explanation and understood what I mean by risk to reward ratio. But you have to get on the chart yourself and see, what works for you. What works for me or what works for another trader might not work for somebody else. But that's how I identify the markets.